Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, August 19th, and this is the weekly market update. The disclaimer, anything that you see or hear on this video or podcast is not to be taken as investment advice. I am not a financial advisor. I cannot give personal financial advice. Please do your own due diligence. It's your money. It's your responsibility. So before we get started, a little housekeeping note. Again, I've been slowly getting the podcast. This is for podcast listeners. Getting the podcast up on Spotify. I got it up there last week. I'll be trying to get it up on Apple. There's some hoops I got to jump through, but you should be able to see those. I'll put a link to the Spotify website where the podcasts are hosted. So people requested that. So it takes time for me to do these things. And then there's some hoops you got to jump through. So we're able to do that and get that going for folks. So we'll look for that in the show notes. The other thing I just wanted to remind folks again was the fact that I will be raising the price of the Actionable Intelligence Alert newsletter on September 1st from $150 a year to $179 a year. Many people have taken advantage to lock in the $150 price. Again, if you subscribe, you'll be grandfathered in at that price. And so when your resubscription comes up, if you choose to resubscribe, you will not incur any of the price increases that have followed on or will happen in the future. So please, if you're mulling whether or not to take a subscription, this would be the time to do it. Okay, let's get into this week's info. So again, a little bit of economic news, not that I use the economic news or for like whether or not I buy stocks. One of the things I've kind of been holding my powder dry on is that, I have the view that I've reiterated several times, many times, that I believe that in the short term and medium term, liquidity and sentiment is what drives stock prices, obviously fundamentals in the long term. And so, we're in a tight liquidity cycle, tightening cycle in the United States. Talked about rates. Everybody knows that the balance sheet is shrinking. Commercial banks have been tightening loan standards, aren't giving as many loans. That's a tightening environment of liquidity. That's not conducive for risk assets to move higher. And so this is one of the reasons why I've, kind of tried to focus on some of these leading indicators in the economy to try to gauge when the tightening cycle in the US will move from, tight to the next, liquidity cycle. And so that's why we follow a lot of these economic indicators, because I don't want to, I have a list, I have a view of various companies and businesses I'd like to buy stock in, but I don't want to do that in an environment where the market might decline because, why swim upstream against liquidity, a tightening liquidity cycle? Why fight the Fed? And now it looks like maybe the market's starting to crack. And this is something that we were anticipating. So we'll see. No forecast here, but I want to focus again on some of the economic indicators, because at some point, we're going into an election year now, and we're like, what is it? 15 months away from the election. At some point, if the economy, starts to deteriorate, what is the pressure going to be on the Fed? What's, the fiscal environment? I mean, we're spending a lot of money. Debt to GDP is way up. The deficits as a percentage of GDP are historically high. So there's a lot of, what I call electioneering coming possibly down the pipeline. So we have to balance all of these things. So one of the things I wanted to focus on, in the HOPE framework that we have been trying to follow, housing, right? So 30-year mortgages now in some places pushing 8%. And so if you've been following the housing market, you know that there hasn't been a lot of inventory coming to market. Why? Because if you have a 3.5% mortgage, 30-year mortgage, why would you want to sell your house and then you have to go live somewhere else? So you either have to go rent somewhere or you have to go buy another house, and then you've just traded in a mortgage at 3%, and now you're going to get a mortgage at 7 or 8%. That's kind of strangling the housing market. There is, family formation doesn't change through various generational cohorts, but this is really stifling a lot of household formation and a housing market because there's not a lot of inventory. So prices really haven't cracked yet. I follow some housing bloggers and YouTubers that follow these things in different areas around the country. Things are starting to crack because it's inevitable, right? I mean, it's not just people selling, it's a whole bunch of things going on. Airbnbs, like, especially I watched a video about the Airbnb situation around Orlando. Okay, a lot of people jumped into these things thinking they were going to this is creating a stream of income, and it's not working out for them and now they're being forced to sell into a market that's declining. And so at some point, if you're going to be a forced seller, or if you can't make the cash flow work on your Airbnb, it would behoove you to sell before everybody else decides to sell. It's kind of the rush for the fire exit. You want to be the first one out the door, not the crowd jammed into the door. So anyways, this is not positive for housing. I mean, it's the interest is a significant expense in a portion of a mortgage. And when we were down at 3% or less than 3%, people were getting long-term mortgages, and now you're up 7 or 8%. It just creates a situation where, with house prices being so high, it's impeding people from buying. Now, we've seen, and like I said, I mean, because it's kind of frozen because of the rate differentials from the mortgages people have in their houses to new mortgages. A lot of houses aren't coming to market, but I think that's going to change. Like I said, inevitably people divorce, they die, they have to move for a job. There's kind of like forced selling going on. So at some point, if you're in a neighborhood and a couple gets divorced and they have to sell the house, and they may have to mark the house down, that's the new benchmark for the other properties in the area, the comp, if you will, the comparison. So it's not 100%, that happens in every neighborhood, in every city, but you're going to have a certain amount of sales just because of death, divorce, stuff like that. So anyways, going back to this tweet, it shows the chart over here. You see the rate increase just in the last year, 18 months. I mean, that's definitely, what the issue is. And it says interest rates on 30-year mortgages are now at their highest in 23 years. New home buyers are now spending a record 40% of their income on a mortgage. Meanwhile, the median sales price of a home in the U.S. is 560% of the median annual income. What's the long-term plan here? So again, housing's just unaffordable. The prices went up because of cheap money, just like a lot of assets were inflated by cheap money. And now there's going to have to be a reconciliation now with these higher rates, and it will take time to work through, but we're starting to see that in some places as prices inevitably have to get cut, because it's not like there's going to be zero sales. Like I said before, there's a certain percentage of the housing market that goes on sale just because of, like I said, people dying, people retiring, moving somewhere else, divorces, all kinds of things that happen to people in their lives. So this is something to keep an eye on. This is Jesse Felder. We follow him on Twitter. I recommend you do that. You can sign up for an email that he has, and he sends out like every Saturday morning. You get like a compilation of his various tweets through the week. They're pretty good. I like a lot of his graphs. He does the same thing. He amalgamates and curates a lot of stuff that you wouldn't find on your own. It says here, the rally in the technology sector was driven in large part by an unprecedented surge of international flows into U.S. equities. June's inflow was by far the greatest monthly flow on record. And you see the chart here that goes back to 2022. You see inflows into U.S. equities, monthly flows. This is foreign purchases. And so there was a quip there that somebody had made that foreigners and dentists are the last ones to buy in a bull market. So, the question is, that's kind of true. It's like the uninformed are the last ones to the party, right? And this is this kind of ties into the previous graphic that we showed in a tweet from Jesse Felder. This is household equity holdings as a percent of total assets. And so it's at the highest, well, at least until this goes back to 1988. But you see, like, even at the height of the tech bubble in the 99-2000 era, and even at the great financial crisis timeframe before the great financial crisis, you see that we're at the highest in 40 years approximately, or at least 30 some odd years, where, equities, stocks, if you will, represent 25% of household holdings. So the question is, if foreigners and the dentists and all the other uninformed investors and the average household, who's left to buy? Who's left to push this market higher? Again, you're sailing into a region of where the wind is blowing against your sails, not in your sails. You're sailing into a liquidity market that's tightening liquidity, and who's going to be where's the new buying impetus coming from to push equities higher? I don't know. I'm not saying that that's, I was anticipating, I have been anticipating, I didn't, you have these bull runs, what I thought was a bear market rally, and it may look like it maybe have exhausted itself now. So again, it's impossible to know the future. I don't know the future any better than anybody else, but we're just looking at current information and, trying to put together a thesis or narrative that, that we can possibly, what I'm looking for, folks, ultimately for the biggest payoff of my career. And I kind of dabbled in this during the financial crisis, but I didn't have the capital that I have now to do it. And I recognize this as an opportunity. Is I'm looking for the high yield bond sector to crack, and it hasn't to this point. But tying into an economic recession that I'm anticipating, I have been anticipating, and to this point, the detractors have been correct. I've been incorrect. That we haven't experienced what I thought we would see. Again, I've said before, I have the rest of the third quarter and in the fourth quarter to see if it starts developing like the leading indicators in history has shown. If it doesn't, then I'll have to reassess. But, what you need to understand, like, about high yield debt is this tremendous opportunity when it goes through a crash. Crashes are typically because of liquidity events. And what happens is when you trade bonds, they're not like you just go on your phone and just do like you do a stock and you just make a couple clicks and you sell. Bond market is for corporate bonds is very illiquid relative to equities. And so when these things sell and there's forced sellers or bad news comes and people just want to sell to get out, you get very big drops in value. It really, a lot of, you'll see things be selling for 25, 30 cents on the dollar. There was a tweet this week that showed during the financial crisis where Buffett, there was like 10 names maybe of junk bonds that he bought during the financial crisis. And, what happens is eventually the crisis passes, the liquidity cycle turns, liquidity comes back, the businesses don't go out of business. And then people realize, well, hey, I got this company trading over here. Its bonds are trading for 30 cents on the dollar, and it has a yield to maturity of 50%. People buy that. And then as things return relative to normal, the yield comes down, but the price of the bond goes up multiples. And so that's a tremendous opportunity. And I've kind of been waiting for that, but I've kind of been disappointed because the high yield market hasn't cracked. Maybe it won't. Maybe this is a new era. Maybe it's going to be a soft landing. Maybe it'll be no landing. Maybe what we saw last year was the recession. I don't know. So, but like I said, I'm following the leading indicators. I'm following liquidity. I'm following history. And so that's where I'm going. And I think some of this stuff is starting to, information that we're looking at here is starting to build that narrative, around that narrative. The free money's out, and people, the reckoning's coming now. People have to pay, okay? And what we're seeing here is this is the percentage of U.S. consumer balances moving from current to 30 days plus delinquent during the quarter by loan type. So you see what's happening with credit card and auto loans. Delinquency rates are climbing. Mortgage delinquencies are climbing. And so you're going to see the same thing with student loans, because people have, because of the legislation and executive orders that the current administration had around suspending having to pay back your student loans. That's changing, I believe, September. And so you've seen all kinds of articles and surveys where 30 or 50% of the people that have student loans will be unable to make their loan payments. And so this is not positive in my mind. This will lead to, this is a consumer-based economy. Consumer spending is 70 to 75, 80% of this U.S. economy. And if people are being, delinquent on loan payments, they're certainly not going to be out there spending money, going out to dinner, throwing cash around. Okay, so something's starting to happen. The return back to normal. Okay, all the free money's run out. All the forbearances are being terminated, and now you're going to have to pay. And people don't really have the money to pay. This is a payment society. I've told the story before that I pointed out to my wife when we bought our last car, which was several years ago. I pay cash for my cars. I have the ability to do that. And you go in there and you're sitting in a little booth or cubicle, and you can hear like some of the conversations around you of people, and it's always about the salesman trying to find what payment the person is comfortable with. It's not talking about like the vehicle value or anything else around that, the interest rate, or none of that comes in the conversation. Can I get you into a payment that you can make the monthly payment? And then everything else is not even considered. And so, that's the kind of society we have. And so when things turn on people, when rates go up and things reset higher, it just blows people's finances apart. And this is what we're starting to see now. I thought this was interesting just because of the commercial real estate situation that I don't think has fully blown up. We're just seeing tidbits here and there, various anecdotal things coming through on the news about this building here or this building there. But what I find is interesting, this isn't just for commercial real estate, it's just kind of society in general, is, title of the slide, employers want people back in the office. And this says, employers want to work from home about half a day a week more than firms are offering. So, this is what companies are saying, and this is what employees want. And so in a tight labor market, if you will, labor has some advantage because people can negotiate the terms better. But what happens if we do see a downturn in the economy and the unemployment rate goes up and people are forced then to take a job because they need a job? Then the employers will have the advantage. I just think this was interesting. I wanted to bring it to people's attention because I think people just say, well, we've got a generational turn. It's not going to go back. With unemployment's 4.5%, 5%, 6%, let's say, in a bad recession, will people be able to demand to work from home more? Or will employers say, if you want this job, you're coming to the office? And what are you going to do if you have no income and your prospects aren't that good? So we'll see what happens. One thing I have learned, because I've got spanked enough in my prognostication career, if you will, is never to say never. You never know what's going to happen. No one can foretell the future. All you can do is, like I said before, is take in the information you have and then using history and experience, try to put together what the probabilities of various scenarios are of playing out. So I thought this was interesting. This guy, I can't pronounce his last name, but you see up here, I'll show you a bigger slide with, because I suggest that you subscribe to this person's Twitter feed and also the periodical they put out every week called Energy Tidbits. But one of the things they were talking about in last week's report was, and I didn't know this, I just heard this through their publication, is that quietly under the radar, Iran is looking at increasing oil exports by 600,000 barrels a day in the second half of 2023. And I had not heard that. And, I think that the Biden administration is not really saying anything. We're supposed to have these sanctions. They're an enemy of Israel. They're our enemy, blah, 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 blah. And so I don't know if their sanctions are still in place or not, but nobody's enforcing anything or doing anything. And, like I said, we're going into an election year, and the last thing that this administration is going to need, I think, as the economy deteriorates, is $4 plus gasoline prices at the pump. And so, the SPR is not really available to them to run another, try to manipulate the market. You got to give them credit. That was a good trade that worked for them, but it's not, again, you can't take the SPR down to zero. You'll damage those salt caverns. And so kind of sneakily allowing Iran, everybody just pretending Iran's not increased. This could be enough to get enough supply on the market to maybe temper prices. I'm not saying it will, but I didn't even know this. And the only reason I knew about this is because I read this guy's Energy Tidbits publication that he puts out for free, by the way. I think it's every Saturday afternoon or Sunday. I can't remember, but it has a lot of good information in it. I mean, it's a lot more than actually can digest in an afternoon, but they kind of summarize it. And this was one of the things. And like I said, this is on the Twitter feed. So it says, who can or will stop Iran from adding up to 600,000 barrels a day to oil markets over coming months? Iran not subject to OPEC quota. U.S. negotiating with Iran on prisoners and release of Iranian funds. See August 9th, 23 thread. Iran is oil supply risk in second half. So it's something to take into consideration, right? Because a lot of people have been super bullish on oil. I think prices in this range right here, 80 to 85, this works perfectly for all of the companies that are in the AIA portfolio that are oil producers. Plus, it works very well for oil field services. I know some people are out there saying oil's going to hit $100, $90, $100 in the second half. I don't know. I know that, Saudi and others, we have the OPEC cuts. Again, that's what's so interesting and so difficult about projecting oil prices. There's so much going on with supply and demand, and you don't need big shifts in supply or demand, to really shift the price much. So, at the margin, shifts in supply or demand can really have an exacerbated or a great effect on prices. And so it's very difficult to forecast. I think that, as long as, my thesis is long term, not enough investment has been made. So I have suggested that, sometime in the future, unknown, we'll see all-time highs in oil. But, especially as now shale's plateauing, but you can't put a timeline on it. It's impossible. And you certainly can't forecast oil prices week to week or month to month. It's just too difficult. I admit it, I cannot do it. Okay. So you just have to kind of get the general, I think, trend over a couple of years, because there is a such thing as a oil investment cycle, I think. And if you try to get that right, then you try to put yourself in position to take advantage of, saying of a period of several years, the oil price will end up higher at a higher plateau than where it started. And I think that's about the best you can do. And if you have that framework, then you can kind of look for the undervalued sectors. Now, a lot of these oil companies that produce oil, I mean, that was the best buy of the decade, buying at the COVID lows, right? At negative $40 a barrel, whatever it was. That's when you should have been buying. That's when we were buying. That's, The videos are there. We were buying. That was a layup. It's more difficult now. Okay, and there's not the same risk reward. The same thing's now happening in oil services. Oil services stocks, especially offshore, that I am mostly in, they have moved a lot already. Okay, so do I think there's still upside? Yes, but it's not the same upside of buying these things a year and a half ago. Okay, everybody on Twitter is talking about offshore oil now. You didn't hear anybody talking about it a year ago or a year and a half ago. So you have to start looking around. Okay, well, how much more upside is there? Is there 3 to 5 times? Is there 10 baggers there? There are some 10 bag possibilities in my view, but you're going to have to go to the Singapore stock market. You're going to have to go to London. You're going to have to really deep dive. You're not just going to be able to go pick the 2 or 3 names on the NYSE everybody's talking about on Twitter. You're going to have to go deep dive and deeper to some areas where liquidity hasn't come to those names yet they are they're starting to turn. So that's what we talk about in the Discord of the Actionable Intelligence Alert newsletter. We talk about a London-based company that provides services for drilling contractors that's trading extremely cheap. So not necessarily all of these things are in the portfolio because they're not appropriate for the majority of people. You have to have an ability to trade stocks around the world via Interactive Brokers or something like that. And not everybody wants to do that or has the ability to do that. So we try to keep it high level, but we have a lot of discussion like in the Discord channel about these really smaller names. So again, this is why it's difficult. We just talked about Iran and supply, adding supply in the second half here in 2023, and yet we still have opposing that the inventory draws that are happening because of the OPEC cuts and the Saudi cuts, right, to production. And so it says here, the inventory draw accelerated this week to 1.2 million barrels a day, with the August average draw at 600,000 barrels a day so far. Okay, so global visible stocks proxy, 14-day moving average. So you see, what's happening, the draws. But again, if you have the August average draw at 600,000 barrels a day, and Iran's going to come with 600,000 barrels a day, does it offset? So this is why it's very difficult to forecast the direction of oil prices in the short term. I wanted to bring this up. This was in the Tidbits, Energy Tidbits periodic came out. And this was, I've talked about this before. I haven't talked about it in a while, but like over time, I've mentioned this several times. Several years ago, I don't know the exact date, but Exxon Mobil talked about, they did some internal research and they were talking about, and they discussed it, I think, in one of their quarterly meetings or annual meetings about depletion of oil fields. Being an extractive industry, it's not any well, any oil field, any large petroleum producing area is eventually going to go through a cycle where it's through discovery, increases in production. Eventually, there's only a certain amount of recoverable oil in place in an area, and once you produce, you get to a plateau. The oil that's able to be extracted plateaus and then goes into what they call decline or terminal decline. And Exxon was talking about this. And what they said is, continue, I think a lot of people don't recognize, they don't factor in depletion into their calculus or to their discussion. Okay. And that's one of the things I keep in the back of my mind, because Exxon had said that, if you're anywhere from 5 to 7% of depletion a year worldwide, I mean, encompassing all the depletion from all the wells and all the oil fields, that's what they estimated. So if you're at 5% and you have 100 million barrels a day of demand, that means you're going to deplete. That's 5 million barrels a day that you have to find and bring online to cover the depletion, and not counting the increases in demand that we see just about every year of 1 to 1.5%. So that would be 1 million to 1.5 million barrels of demand growth on top of 5 million barrels of depletion. Now you're looking at 6 to 6.5 million barrels a day that you have to find and bring online to overcome depletion and demand growth. That's why I'm so excited, because there hasn't been enough investment. We had this big gap and lack of investment because of how shale sucked all the investment out of the non-shale conventional oil. Everything, all the money went into shale, and now it's looking like it's plateauing. And so you have to ramp up now in other areas to compensate for now the plateauing and eventual decline of the easily accessible, low-hanging fruit of shale. And so I'll just read some snippets from this article again. This is why I like reading the energy tidbits, because you get these type of things and really helps you focus on what's really important, not the short-term gyrations in the oil price, but these, you know, geology and this fundamentals that are in that market that aren't going to change based on price. So it says Saudi Aramco CEO Nasser reminded of the key fundamental reason why we have been positive on oil for the 2020s, especially in the face of the underinvestment. The overall decline rate of the global oil production base is 5 to 7%. Aramco CEO, quote, says, considering the depletion of 5 to 7%, and you need to have huge investment just to maintain the current decline that we see in existing mature fields, unquote. The world needs to add 5 to 7 million barrels a day of new production additions just to keep production flat, and demand continues to increase by 1% to 1.5% a year. In the last snippet here from the Exxon CEO, quote, this is what Exxon's CEO said, quote, people continue to forget about the depletion curve, unquote. So I just wanted to remind folks of this. This was, said before. Keep this in the back of your mind. We have to overcome depletion, and we still have, is the investment sufficient enough to do that and find additional resource for the growth that's 1 to 1.5% a year. Everybody says, well, look at what's happening in Guyana. Okay, so eventually that's a prolific new discovery, okay? And it's really ramped up, and it could get to 1 million barrels a day very quickly here in the next couple of years. But that's just 1 year's demand growth. And all of those rigs that are there, all of those people that are working there, all that equipment that's there, all the time it took to develop that, you see now what the problem is. You see what the opportunity is. The tremendous amount of resources that have to be plowed back in just to get 1 year's demand growth satisfied. It takes an entire region, and multiples of rigs, all the people that are involved, all the resources that are involved. And so here's, go on Twitter. Here it is. This is the guy's name. Put it in Twitter at Energy Tidbits. You can go here. There's a way, I think you can, if you go to like this link here, you can sign up for this Energy Tidbits, and they get sent to your email. And I suggest you get it. Like I said, it comes out every week. It's got a lot of stuff in there. It's not just about oil. They have LNG, natural gas. It's it really keeps me, up to speed on what's going on. And like I said, it's free. And this guy only has 8,700 followers. He should have like 80,000 followers. I mean, this is a lot of good information, and not a lot of opinion, just, facts and reporting. It's kind of just like a Wall Street Journal or FT, just on, what's going on in the energy markets. It's a weekly publication. So I find it very interesting. I suggest you follow this person and you sign up if you're interested in the oil and gas markets. Thing I wanted to point out here, I've seen this chart before. This is just showing you the per capita current GDP per capita along this line, and this shows you the electricity consumption per capita. And you will note that as countries get wealthier, you require, well, at least from electricity, more and more energy inputs. This is fundamentally what we've been talking about. This is physics over politics. I like what this person put in here. I forgot who put this is part of a tweet. No such thing as a low energy rich country. This is what it is. You can see the different Norway, the United States, Japan, United Kingdom. They're all up here. You see what the energy demand is. And then you see all these other countries. I'm not going to make fun of them, but like Somalia, Sierra Leone, Afghanistan, Liberia, Haiti. Okay, there's no energy and there's insufficient energy. That's not the only reason, of course, but you see what's required, as people get wealthier in order to facilitate wealth creation, industrialization, modernization, you need more energy inputs. Would you rather live here, especially if you're in the United States or some developed country, or down here? You're not going to solve this by putting up a bunch of solar panels in Haiti. They need thermal plants, okay? That can produce consistent energy as cheaply as possible. This is why I'm so bullish on SMRs and nuclear and things like this. It's just going to open up so much possibilities for things. Like I said, I think the public opinion, even in government, things are changing, and it's now being realized that you're not going to. We're like I said, we're at peak ESG, and I think rationalization is going to come back. Rational thought, recognizing, what's actually true, and having physics and good policy trump politics. Or if you don't, you're just going to become poor. I was listening to a podcast today or the other day, and when I was driving to a construction site, and the person was talking with Jim Paplava on the Financial News Network. And they were talking about how standards of living are decreasing in Europe and getting below thresholds, not fully, but starting to get below thresholds for many people in European countries, which would be considered, what you would see in an emerging market or a developing market, not in a first world country. And a lot of that's because obviously overregulation, more state intervention, and this is my view, and some people won't agree, and you're strangling industry and you're strangling innovation and you're forcing high cost, less dense energy, and it just doesn't work. It costs more, and it has this effect. And so now it's starting, like I said, we have these real-time laboratories where we've tried to do these things, and we see what the results are. You can choose to look at them, or you can choose to ignore them. You can look at California, tell me what the electricity prices are relative to the rest of the states. It's not just all because of renewables. There's state intervention, but it's a mindset. It's a narrative of state intervention, central planning, forcing a technology on, forcing energy sources or energy that's high cost and intermittent on an economy. And it has consequences. Again, here we go. This is something I've pointed out before too, and I've talked about. This is what's known as an S-curve, and it shows you that as South Korea developed over time, you see the per capita you see the absolute demand in barrels a day over on this side. This is the per capita, and you see as the country came out of making industrializing, becoming more technologically innovative, after the Korean War, the country went on this massive development, and you saw as it got wealthier, it went through this thing where it started increasing. And even in the like when I graduated high school in '85, the average consumption was only 3,000 barrels a day, or excuse me, per capita, consumption. You see over time, and then it goes exponential, and then it just keeps growing as you get wealthier, as you have more things, air conditioners, refrigerators, computers, and industry, blah, 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 it requires more energy per capita. and this is what you're going to see in India. This is what you're seeing in China. You can just take the BP energy review, and it tells you how much energy in BTUs each, or barrels of day of oil, each country is using for that previous year, and put it into a spreadsheet with barrels per day. And you could say, okay, well, let's use South Korea as a proxy for the rest of Asia, or Japan. Okay, and take the average. So they're up to, what is it, 19, 20 barrels a day, or barrels per person. And these are countries that don't have big car cultures, right? Because they're small countries. They have a lot of trains and public transportation, and you still use increasing amounts of oil. I guess that's the point I'm trying to make here. Over time, this is what's going to happen. And so that's where you get that 1 to 1.5 million barrels a day of growth, or 1 to 1.5% a year in demand growth, regardless of what's happening. And the trillions of dollars that have been spent in the energy transition haven't really substantially changed that. So this is interesting. So this was I think it was at a WEF conference or something, some kind of conference. But anyways, I think I have a link to the article. I had to do this week's slides on the fly, so I might not have links to all the articles. But this is Mike Werner, who's Google's head of circular economy, said that there's going to be, significant mining is key to net zero. So you're not going to get away from it. This is what I've been talking about. And you see this current administration talking about having this energy transition, which is very mineral intensive, and yet you can't mine in the United States. They're doing everything they can. So you're talking out of both sides of your mouth. You can't do that. And so what did this guy say? He said, Mike Werner, Google's head of circular economy, says companies should move quickly to measure their reliance on critical minerals such as lithium, cobalt, and copper. Google is an advocate of, quote, urban mining, the process of extracting critical minerals such as lithium, cobalt, and copper from aging mobile phones, laptops, and other devices, and reintroducing them into material supply chains. Okay, but here's the problem. He goes on to say, Werner also said it will take moving, quote, trillions and trillions of tons, unquote, of dirt to recover enough critical minerals, including rare earth elements such as dysprosium and magnesium, to build technologies crucial for the clean energy transition, including solar panels, wind turbines, and batteries for electric vehicles and energy storage. That demand, based on 2021 analysis by the International Energy Agency, is roughly 6 to 9 times which would be needed to build comparable fossil fuels infrastructure. See, this is why everybody's going nuclear. This isn't going to happen. We're not going to move trillions and trillions of tons of dirt. And that's done with diesel equipment, by the way, for the most part. You don't have battery excavators in an open pit mine. You have huge excavators and dump trucks running on diesel. So this is why I'm so bullish on uranium, on the nuclear renaissance, which is happening. SMRs, all these technologies, that's where the focus should go into. If you're an advocate of the fact of the hypothesis that CO2 emissions from humans are causing this catastrophic global warming, then you have to be a nuclear advocate, or you're not a serious person. Or you have to advocate. This is the thing that you need to realize, folks. If you're not willing to advocate for that, then you're anti-human. What you're saying is, I don't want you to use energy. I don't want you to have consumer goods. I want you living as a minimalist. And we have not had a referendum on this. It's being forced on some people via, you see what's going on in Europe, where they're being able to slowly trying to get away with it in certain jurisdictions. 15-minute cities. France banning flights between cities where there's train travel. I showed you the 2030, 2050 goals in the UK from a government-sponsored think tank, where there are only going to be 2 airports left in the UK, and basically no one's going to be allowed to fly by 2050 at all. Do I think this stuff's going to happen? No, the people will, I believe, revolt before then. But again, you're really not a serious person, if you think that you're going to move trillions and trillions of tons of dirt so that you can get minerals to build devices, what I call rebuildables, to grab a diverse or this photons from the sun and power an industrial economy. What you're going to have to do is, if you're going to do that, is you're going to have to tell people you're going to have to become a minimalist. You're going to have to live in a smaller space with less goods. And most people are just going to have to, you're not going to be able to move around and have the freedom of movement that you had before. We haven't had that discussion. If you put it on the ballot, people won't vote for it. That's why they're trying to restrict agriculture. That's why they're doing all of these things little by little, mostly in the West. It's not it won't fly around the rest of the world. I'll tell you that right now. It's not even being discussed in other places. The only place it's discussed is the US, is basically the OECD countries, Western Europe, the United States, Canada, Australia, places like that. Will it be successful? I don't know. But let's have a real discussion about this. Most of the people, if they want to reach these goals, are going to have a reduced standard of living. Your prospects for your future are going to be basically not upwardly mobile, stagnant. And, that's how it's going to be. We make fun of this, you'll be poor and be happy and all this stuff. It's not funny. That's one solution to this. The other solution is to let technology and let ideas and let the markets solve this and let it flourish and push these bureaucrats and technocrats out of the way. What have they ever done? What have they ever produced? What theory of theirs has ever worked? Where state control from the top by technocrats, it goes back to what I said before. It's Soviet Gosplan again. A bunch of PhDs sitting around in a room deciding your future based on what, they have been consistent in their lack of success in forecasting or predicting anything throughout history. Turn loose, the technology entrepreneurs, have multiple competing designs for these SMRs, all this stuff, new nuclear technology, reduced regulation, okay? And I'm not saying get rid of it. There has to be, you're dealing with, atoms here, nuclear power. It has to be regulated, but not to the extent it is now where it strangles it. Where you have China, look in the UAE, the success of the 4 reactors that were built there. And then look at Plant Vogtle. They finally got it online, but it's $30 billion. It shouldn't cost $30 billion to build 2 reactors in the United States. That's ridiculous. So I don't think we're going to move trillions and trillions of tons of dirt. That's my own opinion, but we'll see. So here we go. Tweet, the world's largest copper producing country has had only 2 months of rising output over the last 24 months. Not worrying at all. So this is Chile's copper production has been in declining 22 out of the last 24 months. Better get to moving some dirt. So this is the problem, folks. Investment. I mean, Chile's is the top copper producing region, I believe, in the world. And again, at some point, exhaustion gets there, lack of investment, things like this. And this is what you're seeing. This is not going to facilitate the energy transition where you have mining output decreasing. And so consequently, the price will go up for these materials. And that is our opportunity. All right, guys, that's it for this week. Oh, wait, I got one more. This is a Clown World, put it on here. Another one bites the dust. This is Chris in Canada, another guy I follow. I've been following this guy for several years. He has a lot of good tweets. This is the Nikola, which is another one of these renewable vehicle companies, like truck company. You see the stock price, like when all the hype was going on back in 2020, it was selling, above $60 a share. You see what happens. Okay, over time, at some, Lordstown Motors is another one, I think. At some point, you have to make money, folks. You have to have positive cash flow or the enterprise doesn't continue. And so it says here, Nikola, NKLA bites the dust. Another massive EV recall due to safety and fires. Doubt we see pure play electric vehicle dominance in my lifetime. Well, Again, never say never, but you know, it's not looking good. Okay, that's it for this week. Thank you for subscribing. Thank you for watching the videos. I hope you get some value out of this stuff. Again, want to plug the free email newsletter I put out. You know, in addition to the paid newsletter, I actually put out a every Sunday, usually I send it out, or Monday sometimes, a free newsletter. It's, you know, thousands of people subscribe, and I talk about something that's actionable, or something I'm thinking about, or something that's going on in the markets. I don't get into specific picks there, but it gives you a flavor of some of the things that we're talking about in the newsletter, the paid newsletter. And like I said, it goes out to thousands of people. They do seem to find some value in it. You can see the link for that in the comments or the show notes. You can sign up for that for free. Actually, you get a free ebook on where I summarize Bob Farrell's, investing legend Bob Farrell's 10 rules for investing. So it's something that, if nothing else, can incentivize you to sign up and get a flavor of the writing that I do in what I put out to folks. So that's it for this week, guys. Again, appreciate it. I may not make a video next week. I'm going on vacation. I've got some other things going on that are taking up a lot of my time this week, but I'll try to put out something. And but if I don't, I will be back the following week for sure. Okay, talk to you later.